Good morning and welcome to my monthly update on alternative asset fund administrator and league tables. There are over 600 fund administrators and 500 audit firms servicing the private markets. I am George Evans from Convergence. Convergence is a data and analytics firm focused on the asset management industry globally. Note that alternative asset league tables are available only to Convergence clients. League tables can be purchased at the Convergence e-commerce site and at our e-commerce tab. I will provide some commentary on the movement we saw from June 2020 to June 2021 in the market, and I will be joined this month by two Convergence clients, Jay Maher of Mainstream and Anthony Decandido from RSM, both firms with noteworthy performance over the last year. I'd now like to introduce Anthony Candido. He's a partner in the asset management practice at RSM. So Anthony, I look forward to chatting with you today. I thought we could start just talking about growth. I'd like to hear just your thoughts a little bit on your growth model, how RSM these days is focused on the market, and how you think about, both organic and inorganic growth.
Okay. Well, for starters, for those that are not familiar with the firm, RSM is the premier provider of middle market advisory solutions. So we cater to a portfolio of clients that are generally $1 billion of revenue or less. That's not always the case, but generally speaking, that is the case. In our asset management space, that's generally a $10 billion AUM fund complex category or less. We're looking at growth in a few ways. I think some of the more pervasive industry topics that our clients are asking us about today are things like digital transformation and technology, security and privacy. We've got a lot of enthusiasm around our ESG advisory practice today. Of course, with what's been happening on Capitol Hill and some of the bills that have been passed and suggested around infrastructure, taxation, naturally there's a lot of interest there also. So really, our business continues to be steady in the compliance side, and really on the advisory side, where we've got a lot of momentum, enthusiasm for the breadth of service solutions that we have, which, by the way, when I started 15, 16 years ago, was not as robust as it is today. And so that's something we're especially proud of.
Yeah, no, I think it's a good point. I mean, I think what you guys have kind of surrounded kind of that core kind of assurance and tax and consulting business with is impressive. Let's think about the market, right? Very crowded, very, believe it or not, over 500 audit firms named in SEC filings. You clearly have the 80-20 rule with maybe the top 25 audit firms. Wanted to get your thoughts, Anthony, on competition, right? Some of the things you're seeing out there, some of the weaknesses maybe you try to exploit, and then even conversely, some of the hurdles that you guys are kind of attacking.
Yes, what we hear from our clients increasingly is the need to bring industry expertise. So, our firm has been very focused over the last 10 years of prioritizing what those industries are. So to rattle off a few, it's financial services and real estate and consumers and industrials and technology and healthcare. But what I've learned over the last 3 years especially is that organizing that way is a good start, and yet clients increasingly want us to focus in sectors. So when we peel back the onion a bit, and I'll comment on the industry that I focus in, which is financial services, then you learn that you've got an asset management community, you've got an insurance community, you've got a banking community, and on and on and on. And as you go further, asset management is private equity and hedge funds and BDCs and registered investment advisors. So when we show up, we need to show up with that sector specific industry expertise. And back to some of the comments I made earlier about how proud we are as a firm of some of these expanded service solutions. I think when clients select us, they select us because they understand that we can be with them through their business life cycle. Meaning, if they're early stage, we've got certain solution sets that cater to that type of profile of business. And as that company may achieve a higher level of organizational maturity and they have deeper needs, then we can be there for that journey. So to the comments made about compliance is the bedrock of our business. I personally don't think we would be as strong in advisory if we didn't have the compliance function that we have, and yet we wouldn't be as strong on the compliance function if we didn't have the advisory side of the business too. So I think that intersection between the two is very important and probably something we'll continue to focus on as a firm.
Yeah, very complimentary. I agree. You talked a little bit about ESG, and my thinking is maybe you could expand a little bit about that and how you guys think about that marketplace and that development and really, where the firm is focused.
Sure. So we have designed a solution set referred to as societal return on investment, because in ESG today, there still are plenty of naysayers who question whether or not the change in ESG behaviors drive improved financial and non-financial corporate result. And so this proprietary tool that we take, it enables the correlation of those changes in behaviors to improve financial performance. And it's something that has gotten a lot of interest from the market in terms of, new deals closed, expanding services with existing clients. And then secondarily, over the last 2 years, we've designed what we refer to in-house as RSM's rapid assessment tool. And this is catered to companies that are on, the lower end to medium end of the middle market, who are simply beginning their ESG mandate. So there's a heavy level of educational need on things like, tell us a bit about all the various financial reporting frameworks and how they're different. What are the similarities? What are the types of accounting specific KPIs that we might measure within the sector that we operate? Understanding that, a real estate type of company has different focus areas than, say, a consumer's company might have. But then the fun of the exercise in my mind is all centered around the benchmarking that might be enabled through the work that we do. First, starting with, that company period to period. So most often that's on a quarterly basis, sometimes on an annual basis. But over time, again, as we achieve a greater level of maturity, benchmarking to the outside. Could be to public companies that are comparables. It could be to other private business that are in their sector, whether it's geographical or otherwise. And I think there's a lot of value in companies looking under the roof to understand what that is, so that they could begin to make better informed decisions organizationally.
Yeah, and I think I may have read even yesterday that the SEC continues to look at this in terms of their guidance, right?
Correct. Yeah, and that's exactly right, George. And we follow very closely from a regulatory standpoint what's happening. We've got relationships on Capitol Hill with some of the policymakers, and I think where the puck is headed in all this is the need for greater, financial reporting consistency. So you're seeing a lot of the, governing bodies, whether it's AICPA, they've got a sustainability council, or it's the Center of Audit Quality has another one. Chamber of Commerce is focused on is really converging these reporting frameworks so that there is, better measurement across the board. Now, in that same way, we're taking a really big bet as a firm around what may come in around the way of private company verification and attestation. And specifically what I mean is right now the market is trending towards a greater number of middle market clients preparing ESG reports, but then you come to the realization that that's inherently limiting because all that information is self-reported by the management teams themselves. So where the puck is going and where the market's trending towards is the need for these reports to be independently verified. And that, back to the points that we made earlier of how important it is for us to be advisory by nature, but also stay true to the compliance side of the business, is it's incredibly complementary. So to be in the ESG business, we can't just be in one, but instead need to be in the both. And the very last thing I'll say about this is a lot of the calls that we've been taking recently, clients are especially interested around, what are some of the immediate wins that will have organization in the way of incentives and credits from a taxation and planning perspective. And there isn't enough general regulations around it that apply to every industry. We're finding that instead there's a lot of industry specific regs, but nonetheless, that also plays into what we do in the way of tax planning and state and local tax and that sort of thing, which is pretty cool.
Yeah, no, I agree. In fact, and as you know from our data, we look at different factors. We have over 60 today that kind of make up the infrastructure of an advisor, and we're working diligently to kind of create an ESG related factor for every advisor, right? And kind of just an additional lens in. Let's switch gears. I want to talk to you about hedge funds, right? It's always an interesting topic, right? As you know, over the last few years, hedge fund growth has, with the exception of the last year, hedge fund growth was dwarfed for a very long time by closed-end growth, right? PE, VC, real estate. I think we were seeing in the last year hedge funds, the number of funds not growing, but the assets are, right? And it's clear to us that that hedge funds are growing through either appreciation or growing through more money into existing funds. Curious what you guys think just in general these days about the hedge fund market.
Yeah, I see the hedge fund market going through, some form of, transformation because of, the passive investment popularity that's come over the last so many years. I think we've been in a, bullish economy for a while, pre-pandemic, which played into, the reality that a lot of these passive funds perform quite nicely. The minute that things, slowed during the pandemic and such, I think you started seeing affinity more for the allocators and the investors to draw more towards a more active type of strategy. But when I talk about the transformation of hedge funds, I think of it much in the way of some of the technologies that are enabled there to do a lot more in the way of algorithms and business intelligence and having trigger alerts to invest this way and versus another way, which, directly or indirectly plays into the work that traditional analysts would have done previously. Right. So it's still a market that's very much alive. I mean, we follow what's happening that way quite closely, and we continue to cater to that community. So by no stretch of the measure do we see that coming out of favor, but I think it sometimes gets overshadowed by the enormous interest that we've observed in private equity because it drives water.
Yeah, I mean, if you think, we would tell you that give or take, there's about 100,000 private funds managed by the 19,000 or so SEC registered advisors, and probably 85,000 of them are closed end, right? So all right, let's switch gears. We're going to pivot. I want to pivot a little bit to risk, right? Yeah. So all over the news the last few months, Archegos, family office, the scandal, and just wanted to get your views a little bit on risk, maybe any extra steps RSM took in terms of protecting the firm, and kind of all the discussion that comes with an event like that.
Yeah, I think risk management is definitely at the forefront of all corporate agendas now. This probably being one of the many examples that happened. COVID's another big one. That particular example showcased to me one, the buying power of that community of, we call them meme traders. I think it also begins to showcase some of the demographic shifts of who are our clients and who are our future clients. So there is a need to cater to that population to an extent, but then there's a little bit of clashing of two views of the accredited investor type of discussion, which we all know that for years there's a lot of specifications that were required to enable someone to invest in a particular strategy, and now we learn that that's not so true. So I'm very interested from a policy perspective, what happens for the role government might play in helping people protect themselves from themselves, if that makes sense. Meaning, you hear some really dreadful stories about people who borrowed on margin and they lost their pants in a pretty complex trading strategy that they otherwise wouldn't have fully understood. Yeah. So I think there has to be a correction in that way. When we think about our own business, I mean, we've got very sound risk management practices, but I mean, I must admit a lot of our clients do ask about that in their own, diligence efforts, whether that's in existing relationships or new relationships. So, we're very focused around protecting confidential information of our clients, think social security numbers, date of birth, addresses, all those things that would play into someone of stealing identity. From a technology standpoint, our clients were very interested during the pandemic around, our disaster recovery policies and procedures. So we're really proud that, in essentially 2 business days, we became an entirely virtual organization with no business interruptions. And did we have hiccups in between? Of course we did, but nothing that, created a enormous level of business disruption. So those are a few of the things that run through my mind.
It's well said. I mean, we found even very simple things like the caliber of the filings they did, or the lack of filings that they didn't do, right? So there's some real flags that could have been paid attention to. All right, we have two more items, and you kind of touched on the one. So I want to talk a little bit about the core services and kind of what you've surrounded that with. I think you did a nice job talking about that earlier. Anything else you might want to add to that topic in terms of what you guys bring to the marketplace beyond the core?
Yeah. So one thing to add there is, like, when I think about our business makeup and how we best serve clients, I think that we need to be very thoughtful around designing a sea of talent that have complementary sets of skills. So in my own personal upbringing, there always was a discussion around, technical wherewithal. So as a technically trained auditor for the first 12 years of my career, that came in the form of financial reporting understanding and understanding GAAP and private equity, because that was my industry focus. And those to me are really all table stakes. But when we coach young people today and we think about the best way to show up in the way of client service, I think of everyone having a unique and distinct set of skills that are complementary to the business. So maybe you have an affinity for technology. Maybe you're very well read on industry topics. Maybe you're someone that is great at organizing people. So whatever that might be, for anyone that's listening, I would just encourage them to kind of celebrate those unique, attributes that they possess. Because when you're a part of a firm structure like we are with 13,000 people, we don't want everybody to show up with the same set of skills. We want to be a sea of very different types of skills that show up best in client service.
Yeah, I think that's and the challenge for management is to recognize that, right, in each person, and then clearly, how do you bring all those people together in an organization to be effective, right? All right. Lastly, and not a loaded question, but we just wanted to talk briefly about data and AI, and we have obviously a very long-standing, great relationship with you guys, and I think the Convergence data has been very helpful in terms of how you guys look at the market. But would just like you to just comment lastly on just your views on data and AI these days in your world.
Yeah, so data has really, again, moved up to the forefront of all corporate agendas. It's not a nice to have anymore. It's an essential. To me, when we do advisory work and we get quizzed on, our data partnerships, our data solutions, like, I think one of the biggest market problems still to be solved is how do we organize disparate systems in the way of a very seamless customer experience. I see so many data providers and solution sets that are able to solve a problem, and there's a fewer number that are able to solve a lot of problems at the same time, and to create that kind of interface experience for a client that is not causing them with extra hours or extra stresses. And so that to me is the types of partnerships that we most actively seek from the market.
Yep, sounds good. Well, listen, I want to thank you for joining us. We've really enjoyed working with you and with your team, and and I wish you continued success, and have a great rest of the day, and look forward to your thinking as we keep talking about these great topics every month. So thank you, Anthony. Greatly appreciate it.
Appreciate you saying that, George, and we very much value the partnership with Convergence. So thank you so much.
All right, we have a terrific guest this month, Jay Maher, who's the CEO of North America Mainstream. Jay, a longstanding client of Convergence and has been a great client of the firm. Welcome, Jay.
Thanks, George. I appreciate you inviting me to this podcast.
Well, listen, it's good to have you here. And before we go through a few questions, obviously there's big news in the market about Mainstream and Apex. Just wanted to your reaction to all that.
Yes, as you may have heard in the news, Apex is acquiring Mainstream Fund Services, our global firm. pending regulatory approval and final shareholder vote, which should happen in the next 90 days. And we are super excited. We know Peter Hughes and the company he's built, and we're happy to be part of the team and to continue what we've done here at Mainstream for our customers.
Well, I think it's a terrific transaction. As you know, Apex also a longstanding client, and we certainly know Peter and his management team. So you're joining really a great firm. So listen, what we do here, Jay, is we talk about some things that I think our audience likes to hear. And I always like to talk a little bit about, because everybody seems to be a little different, about their growth model. And really, I'd like to hear a little bit about how Mainstream thinks about growth, how you focus on both kind of new and organic growth in the market.
Sure, absolutely. I think growth really starts with service, right? This is a service industry, and you got to have exceptional client service. So you have to have the right technology tools. And when you have those things, you will get your organic growth. We are seeing a lot of fund 2, 3, 4 that come right our way. We see special purpose vehicles, co-invest vehicles. And it's just a great feeling when your client calls you and says, we love your team, we love the service model, we love your technology. Let's talk about Fund 3 we're launching next quarter. So we're seeing a lot of that. The Mainstream US team is new to the market the last 3 or 4 years. So a lot this year in particular, we're seeing a lot of organic growth. So that's very exciting. And we build on that. Other areas of growth are our emerging managers. Thanks to our data that we get from Convergence, we're able to target new products, new managers coming to the market. So we're always looking for emerging managers. Size does not matter to us. We're not one of these firms that says, oh, you only have $50 million to launch. That's not for us. Call us when you grow in a couple of years. We like to get in early with relationships. We like to build them up. I have many examples of clients that have started small, well under 25 million, and now today are hundreds of millions of dollars in AUM, and they really fit well into our model. So we like to look at those relationships. We look at their past pedigree, those managers, what their product is, where they're, what they're invested in. We have a lot of emerging managers in the cannabis space that we're focusing on, and and it is an investment for us those first couple of years on the smaller emerging managers. It's an investment of our time and resources, and a lot of times those pay off. So we're always looking for that as part of our growth model. There continues to be switches in administrators. There are a lot of administrators. There's still consolidation, as we just mentioned earlier on this podcast, in the space. So people will switch administrators. If you're not bringing your A game and you have high turnover, they're going to look for another administrator. So that's also part of our growth strategies. The managers who are underserviced, and we're going to target them all day long. And we know we're going to bring our A team to them, and we're going to win some of those accounts. And that's happening every year. So we do see that. And one last thing about our growth is, being part of the Apex family, we're definitely going to be doing more with institutional LPs. We have technology to service them, and we will be focusing on institutional LPs, and also family offices will be a target growth area for us in the coming years.
Well, I know it's exciting times. So I actually remember years ago, you and I standing at a high top table at a Price Waterhouse conference at the Marriott. And one of the first things you talked about when you were building Mainstream at the very beginning was it was all about service, and it was all about really bringing a premier service organization. So I think you guys, it's been impressive to watch what you guys have done so far. Now, you talked a little bit about the crowded field. So there are probably about this, it changes every day by a couple, but about 650 administrators in the market today. Which is kind of a staggering number. But when we talk about competition, right, what I'd like to hear your thoughts on, Jay, are, weaknesses that, I kind of put them in two buckets, right? One are the weaknesses. So some of the things you see in the market that Mainstream, and now mainly Mainstream/Apex, will exploit or does exploit. And the second, kind of conversely, right? What are some of the hurdles you see, right, for your organization that you're attacking, right, in the market?
Absolutely. No. Yeah, I mean, competition is crazy. When I was first in this industry 20 years ago, I knew all my competitors on one hand, and I knew everything about them. When I started up 4 or 5 years ago again, I couldn't focus on my competitors. There's too many of them. I had to focus on myself. Like, what am I going to bring to the market? And I don't even read your top 10 league tables. I might next quarter, now that I'll be part of the top 10. It's just too much. Right? There's just so much information about my competitors. So we really focus on what we do. But from winning deals, and we have a very good hit rate. We have over a 50% hit rate when we get to the table with a prospect. And what we find is, and it still kind of surprises me, is that some of these firms just aren't up to par with their technology. Their web portals are dated, like their investor web portals are not top of the line. And so we still see that as a weakness. Definitely the depth of their teams, right? Technology is important, but you need people around your technology, right? You got to put data into the technology. You got to take data out and report on it. So the depth of our competitors' team is just not there. They don't have enough of the experience. We see new players come into the market who may have started out as a small technology firm. Now they're trying to provide services, but they don't have managers on their team that, really know complex waterfall models, that deal with structures that have multiple tiers in them with feeders and SPVs and co-invest vehicles, and that there's different fee structures at each tier, and how things really should work in the technology platforms, and how things could be, flow through the structure, and you can do more efficient reporting, and then set your CFOs and your internal people at the client up for success on their quality control review, right? When you have an efficient workflow. So we still see a weakness there on a lot of our competitors, and also just overall quality control. Some of my competitors, they might be a little weaker on technology, but they're good on their quality control, so they're doing well in the market.
Yeah.
So
how about the flip side, Jay? Like, and this might change obviously with the transaction, but just the things that you feel you're up against sometimes.
Yeah, my biggest hurdle the last few years was branding, right? Because I was a new player to the market after I left my former firm, and a couple of the challenges I faced were Luxembourg capabilities. I lost some of the, I wasn't getting invited to some of the table at some of the larger managers who raise EU capital in the EU. That's gone away now. Now we're going to have a good Lux team to work with. I already got deals in the pipeline that have reemerged, and those discussions are going on. So I think that was one of my biggest hurdles, was branding who we are, explaining why we're different, and then some of the capabilities outside the US that now I have full access to. So
yeah, well, it sounds like this whole Apex transaction is going to obviously plug those holes pretty quickly.
Right.
Once in a while we like to talk about some of the very topical things, and wanted to talk just briefly on this about ESG, right? Your view on ESG do you think it's a big part of growth? Do you think it's a big part of your strategy going forward?
It is a buzzword. I think it's maybe thrown around too loosely. What is ESG exactly? And I think there's going to be some regulation potentially around it, using ESG in your marketing and capital raising. Are you really investing in things that are considered ESG? So look for that to come down the road. We're looking at it right now as a case-by-case basis, more of a custom consulting approach to the market. We at Apex will have reporting tools and analytics around ESG and some ratings capabilities that are coming out. So definitely there's definitely going to be a focus. Peter is definitely focused on ESG, and we are investing in the space, both from a technology perspective and systems, and also expertise, resource expertise around it. So we're excited about that. And I think there'll be regulation coming down the road eventually around it.
Yeah, I think you're right. We agree with that. Let me move to the kind of the market, and I want to get your thoughts briefly on hedge funds. So, over the last 4 or 5 years, right, as you well know, right, most of the growth in the market has been kind of closed end, right, kind of dominated by PE and real estate and VC, and hedge has kind of decreased and even, had treaded water a bit. In the last year, and you'd find this obviously in our league table work, right, that while hedge funds are down, the number of funds are down about 5 or 6%, the assets are up almost 12% over the last year. And, and much of that is appreciation given some of the years the hedge funds had, but we're also seeing a lot of net inflows, right, into new hedge funds, into existing hedge funds. Your thoughts just on hedge as a strategy, your views on hedge in the marketplace, just the whole open versus closed end focus.
Sure. No, I think you hit the nail on the head a little bit there, though. It seems like the larger funds will just get larger, and the medium and small funds, kind of, some of them hang in there, and and then kind of fade away. So we feel like that's what we see in the market. However, there are a lot of products, whether they're credit, loan funds, real estate, that have an open-ended structure to them. Some of them might not be your traditional monthly closed hedge funds. Some of them are doing quarterly, distributions and things like that, but they're still open-ended. They're letting new monies come in, more like an evergreen structure. So we are seeing this sort of hybrid, a little bit of a gray area. Is it truly a closed-end fund? It's maybe has some private investments into it, but it's really acting as an open-ended fund. So we see a lot of products like that in the market. But your traditional hedge funds, yes, there's a few small launches here and there. We don't see this huge influx of new smaller launches. It just seems like if people are going to invest in hedge funds, why gamble on a new manager? We're going to go where we know, the people know how to make the returns. We've been doing it for a long time. So we're seeing the larger funds get larger.
Yeah, I agree with that very much so, Jay. And the numbers actually, really do support that. All right, I want to move to risk, right? And what was very topical in the last month or two was Archegos, right? Even though a family office, it really raised the whole specter, especially in the prime industry, about risk and risk management. As you think about it, my days working at Morgan and Bisis and Globop, right? There were very robust risk programs relative to onboarding new clients and the like. So just wanted to chat with you a little bit about kind of how you think about risk, how you think about taking on clients, how you even look at it in terms of your existing client base.
Yeah, definitely. Well, taking on clients, we have a pretty extensive due diligence on clients, managers, and the principals of the management company. So we're pretty intense about that. We dig deep into their background, see what type of trading issues they've ever had in the past, if any sanctions, and things like that. So we take that very seriously, and that due diligence goes all the way up to the compliance team, and everything has to be signed off before we actually take a client on. As far as how they're trading and the thresholds and things like that, it is the responsible of the fund's compliance officer to really have oversight on that. But as a TPA, we do have some responsibility to make sure we're educating our staff, right? That we understand the investment policy of the fund manager and it's being followed. And if there's any red flags, we need to raise it, whether we raise it to the fund manager first, our internal compliance officer, their compliance officer, or any of the other regulatory bodies if necessary. So we do have things in place to make sure that our team is educated on an annual basis, on a regular basis, that we're getting training on what they should be looking for. And then there's thresholds. So we have reporting capabilities that look at certain thresholds. If this firm had too many swap transactions, and it's looked at, if they own more than 5% of one particular company, those things are flagged and looked at, and we need to understand why, and does that fit into their trading policy? And if not, we escalate it immediately. We have our own compliance officer internally, and then we have relationships with the compliance officer of every fund manager. And if a fund manager doesn't have a compliance officer, or maybe someone's wearing 3 different hats and one happens to be the compliance officer, that's a little bit of a flag for us.
Yeah, that's a big red flag.
That's a flag. And that might be someone we're not going to do business with, because we can't put all of our clients and their investors at risk from doing business with a fund manager like that. Right.
And it becomes challenging because sometimes those startup funds and those emerging funds, right, don't have the bucks to hire the whole C-suite. People wear multiple hats, but that changes as they get bigger. So yeah, no, great answer and appreciate that. All right, 1 or 2 other things, Jay. What I've noticed in the last few years, just with some of the work we do in the marketplace, is fund administrators are not just fund administrators anymore, right? They're really surrounding fund administration with lots of other services, right? Reg tech, compliance, outsourced CFO, outsourced CCO. We saw that in a big way with IQ EQ buying Constellation and Blue River, right?
Sure.
And so curious just to hear your thoughts on kind of what you're hearing from your clients, what you're seeing, in the market around, the top few things that people want to surround fund administration with, right? So they can go to one service provider, have one partner, have one relationship. Curious what you think about.
Well, I think one area, which is not a new area, but you'd be surprised of how many fund managers don't do enough in this, is the AML and KYC compliance to set the investor level, right? So that's something we've invested in this product called Phenomial. and we use it, and we have a very robust offering for KYC and AML on our managers, investors. And, it's not regulated yet, but it will be eventually by the SEC of what is your AML KYC. Right now is best practices, but we believe there'll be regulation going forward. So we're very stringent. We're going through this education process with some of our fund managers who used to just do the bare minimal KYC AML with their counsel. Maybe they collected the subdoc, they reviewed a few things, they sort of know the investor. Now it doesn't matter who the investor is. I mean, we have famous people globally, in our funds. We have professional athletes. We have people, household names that oh, I know that person. We're still getting their passport. We're still getting their driver's license, proof of address. All those documents that you really need to have on an ongoing basis. And then we have a very robust way of doing ongoing AML. So I think that's a service that a lot more of our clients are taking advantage of and we're offering. So we're going to continue on the compliance route because to me, that falls under the compliance. And middle office services, loan servicing. We're seeing a lot of both on the open end and the closed end funds. We have a lot of credit funds and funds that need loans serviced. So we're providing that. We're going to grow that area of the business for sure. Real estate. Right now we do the fund level real estate, but we will be doing some stuff around the properties and consolidations. So I think our offering will expand there. And then earlier we mentioned ESG reporting. So I see some new products and new offerings that we're going to be doing.
No, that's a nice kind of surrounding package. I think what's interesting too, we get involved with a lot of the, consolidation and acquisition activity out in the market. And we're seeing a lot of people really looking hard at middle and back office, and they're really looking at lift outs because of some of the premiums, right, that are getting paid today in acquisitions. There's some administrators saying, hey, it's cheaper to lift out 4 back offices than go buy those assets from somebody, right?
We have a target list all day long of those.
Yeah, right. Yeah, it's interesting. Okay, lastly, and not a loaded question, but just wanted to hear a little bit about your thoughts about data and AI and kind of how you guys use that to at a firm wide and an enterprise level these days.
Obviously we're a client of Convergence. We like your products. You guys keep evolving your product, which is great. And I think we added some more things on this year. And I think we'll add more as we continue every 6 months and see the products you have, your portals and things like that we can, but we take it very seriously. I think data is important, understanding a little bit of the past trends and where the market's going. So our sales team and our business development can target what we should be doing in the market. And then so our operations team could be building services to service that market. So, we like the Convergence data. It's been very helpful and, it's been a big part of our business.
Yeah, well, listen, you guys have been a great client. So I want to thank you for joining us, and 2, congratulate you on kind of the Apex move. You've done a great job, Jay, and you and your team building this firm very quickly and into kind of a formidable firm that was a nice target for a big player like Apex. So kind of well done. We wish you the best. We'll see you in the market, and we'll see you hopefully in person soon. And just thanks for joining us. We appreciate your time.
Thanks for having me, George. I look forward to joining the top 10 on the league tables now.
All right, sounds good. Let me start with some comments on market growth for fund administrators. During this time period, advisors disclosed over 96,000 private funds. That's a net increase of 3,200 funds, up about 3.5%, and assets of over 23 trillion, an increase of almost 13%. The top 25 administrators won 48% of that business, while all other administrators won 18%, and advisors who self-administered kept about 34% of that business. So that continues to be a big market, the self-administration market. The top 25 administrators won 54% in new fund assets. That's about 1.3 trillion. All other administrators won about 11%, and those who self-administered kept about 35%. On the fund administration front, we continue to see very strong year-over-year growth in PE and venture capital funds and assets. On the hedge fund front, while down about 6% in terms of funds, hedge fund assets grew almost 12%. And most of this increase was driven by appreciating markets and net inflows into existing funds. Let me last make a few comments of just about market growth and within the fund administration peering that we do. So if you think about assets were up about 13.5% year over year in that June to June. And the top 5 administrators were up about 10.8%. So pretty much kept pace with market growth. The 6 to 10 peer group was up about 16%, so a bit over market growth. But the 11 to 25 peer group grew close to 22%. And that's a very significant increase over the 13.5% growth in the market. Let me switch now and move to the audit front. We saw for the audit firms, advisors disclosing over this last year, over 96,000 private funds. And that's a net increase of 5,000 funds, up about 5.5%. They disclosed assets of 23.4 trillion. That's an increase of about 2.8 trillion. And that's up about 13.5%. Interesting, the top 25 auditors won 70% of all new funds, while all other auditors won 6%, and almost 24% of funds did not report a fund auditor. The top 25 auditors won 89% of new fund assets. So really dominating the new assets and asset growth that came to the market. On that front, we continue to see very strong asset growth in PE, VC, and real estate. And then just like we mentioned in the fund administration section, on the hedge fund front, while hedge funds themselves are down about 4.5% in terms of number of funds, assets grew over 12%. And again, this was due to appreciating markets and new inflows into existing funds. Lastly, I want to just talk a little bit about the peering and in the audit world and where we saw that growth. So on the fund side, we saw market growth of about 13% for that June 20 to June 21 time period. The Big Four grew at about 12.9%, so very much at pace with market growth. 5 to 10, though, grew at 25.5%, which is almost double the market growth. So that's a very interesting phenomenon that we should continue to explore in our discussions. Firms 11 to 25 outpaced the market really at about 15, almost 16%. So, if you take a step back, while the Big Four kept pace, 5 to 10 and 11 to 25 really outpaced the market. So it's really an interesting discussion that continues about advisors really spreading the jam and moving assets and funds kind of down market. I want to thank our guest this month for a great conversation and really some very good topics. And we at Convergence wish you all well, and we will see you all next month.